So finally, still in your textbook on page 721 and looking at P16.5a, I have calculated cash generated by operating activities, cash used for investing activities, and now I need to calculate cash flow from financing activities, which is cash related to either the issuing or the maintenance of the methods of financing the company uses for its assets, or since we've already dealt with current assets and current liabilities and long-term assets, the only thing left is long-term liabilities and shareholders' equity. So that's what I've set up over here. I'm going to start with our only long-term liability, which is mortgage note payable. In this case, mortgage note payable increased by $45,000. Now we already knew about that because we were already told, and it had to do with this land, that $100,000 of land was purchased with a $55,000 down payment, and the rest, which $100,000 minus $55,000 is $45,000, was the form of a mortgage note payable. And so because the difference between the beginning mortgage note payable balance and the ending mortgage note payable balance is exactly the amount that we know we got the mortgage for when we put that down payment on the land, we've already dealt with the cash flow related to this transaction, and we don't need to do anything else. Now, in other questions, if this were a bank loan or perhaps bonds payable that increased, you would say either took out bank loan or issued bonds, and you would add that increase in the long-term liability. We don't need to do that here, so I'm going to move on to the common shares account. We have to think what would happen over the year to common shares to make this account balance go from 167,000 to 217,000. On the right side of this account would be its increase side. That's where we would issue shares. On the left side of this account would be its decrease. I spelled issued wrong. On the left side of this account would be its decrease side. That's where you would repurchase shares. Now, we also know from the additional information that common shares were issued for $50,000. And 167,000 plus 50,000 does equal 217,000, so nothing has happened on the left side of this account. And so I'm going to go to my cash flow statement, and I'm going to say add cash flow from issuing shares of $50,000 because you would have debited cash and credited the common shares account. And finally, we need to go looking for dividends, and that's exactly what it is. So even if a question doesn't say anything about dividends, you have to go looking for them. I say that because we're lucky here. We have a dividends payable account, and that's mentally cueing us to go and look to see if the company paid a dividend. But it's possible that the company declared and paid it in the same year, and so there is no dividends payable account. And we're going to use the retained earnings to see if there were any dividends or not. So we know that retained earnings increases with the net income because you close your net income accounts into the retained earnings, and we already know the net income because we used it in the operating section. But we can see that 215.5 plus 108 does not equal 261,350, and so there have been debits to the retained earnings account as well, and debits to the retained earnings account are the result of dividends that were declared during the period. And so to calculate them, I'm going to find the number that makes this account balance, which would be the beginning balance plus all the credits minus the ending balance. So 62,150 was the amount of dividends declared, but because we have a dividends payable account, that's not necessarily the amount of dividends that were paid. And so the transaction for declaring dividends would be debit dividends declared, credit dividends payable. So this 62.5 would have been credited also to the dividends payable account. And clearly 5,000 plus 62,150 does not equal 750, so there have been debits to this account, and that amount would be the dividends that were actually paid during the year. So I will make this account balance by figuring out how much debit we would need to get the ending balance to 7,500. So there's our number. Dividends paid would be a cash outflow, so I'm going to subtract it from my cash flow statement. I'll make that a negative because it is an outflow. And so I've now dealt with my long-term liability, my shareholders' equity, and my dividends through two accounts, the combination of retained earnings and dividends payable. So I've now dealt with the change in every account on the balance sheet except for cash. And so I'm going to calculate my cash from financing activities, which looks like it's going to be negative. So this is cash used for financing activities. And I said we had not accounted for the change in cash yet. That's how we're going to make it balance, or that's how we're going to see if it balances. So the balancing procedure, to know if you've done this right, is first to calculate cash flow for the year by adding together my operating plus my investing plus my financing. And I get a negative number telling me that according to everything I've done here, cash should have decreased by 30,400. So if I now add my beginning cash balance to that, so the year end here is May 31st, 2014. So the beginning cash balance was May 31st, 2013, and from the balance sheet it was $43,000. If I'm correct, then by adding together the cash flow from the year plus the beginning cash, I should get the ending cash balance, and I did. If I go to my balance sheet under 2014, the cash balance is $12,600. So I have completed my cash flow statement correctly because cash flow for the year plus beginning cash balance equals ending cash balance. So I'm going to label that cash May 31st, 2014, which was the end of my year. And because I'm finished, I'm going to double underline. So the steps in completing a cash flow statement are: begin with your net income, take out the effects of non-cash items, analyze your current assets and current liabilities, calculate cash from operating activities, analyze the changes in your long-term assets to calculate cash from investing activities, calculate the effects of changes in your long-term liabilities and your shareholders' equity accounts, including checking whether or not you've paid dividends, to calculate your cash for financing activities, then add together operating, investing, and financing activities to calculate cash flow for the year, add your beginning cash, and hope it results in ending cash.